right, welcome to Iron Financial. This is where we help you forge a stronger portfolio and cut right through all the market weakness. Today, we're putting on our hard hats. We're grabbing the blueprints for Toronto-Dominion Bank. Now, they just dropped their latest earnings report, and frankly, the headline numbers look like they're building an absolute skyscraper of profits. But our job isn't to admire the architecture. It's to stress test the entire structure from the deepest foundation right up to the spire. So let's get to work.
So, right out of the gate, the bank is posting record numbers. It really is a testament to what looks like a well-executed plan. On the surface, you're looking at a fortress.
Whoa, hold on a second. Record numbers are fantastic for a press release, I get it. But we're not just here to look at the nice, fresh coat of paint. We're running a full-blown structural inspection. You know as well as I do that huge numbers can hide even bigger problems. The real question is this: can this structure actually withstand a storm? Or are we just looking at a beautiful facade with a foundation that's already crumbling? That's what this entire explainer is about.
Okay, let's get right down to it then. We're starting at the bottom with the foundation that absolutely everything else is built on, the Q1 2026 numbers. Look, in a quarter where a lot of people were bracing for caution, TD came out and delivered a powerful statement of profitability. It sent a very clear signal to the market. This is the bedrock of the entire bull case, so let's inspect it really closely.
And here we go. This is the cornerstone. $4.2 billion in reported earnings for one quarter. Now, you have to understand, this isn't just a number on a page. It's a declaration of strength. In a market that's filled with uncertainty, TD is basically pouring a thick, reinforced, concrete foundation of pure cash. This is exactly the kind of number that makes the big institutional money sit up and pay very close attention. It's the baseline for our entire analysis today.
Now let's pop the hood and look at the engine that's actually driving that massive profit. We're talking about a 13 basis point expansion in their net interest margin. For a bank of this incredible size, that is a significant move. This isn't just them, trimming a few costs here and there. No, this is them fundamentally increasing the profitability of their core business. Every single dollar they lend out is now working harder for them. This is one of the main pillars holding up that multi-billion-dollar profit figure we just saw.
So what does this actually mean? The crucial point to understand is that net interest margin, or NIM, it's literally the lifeblood of a bank. It's simple, really. It's the difference between the interest income the bank earns from all of its loans and the interest it has to pay out to its depositors. A wider NIM just means a more profitable bank. Simple as that. And a basis point, well, that's just 1/100th of a percentage point. It's how we measure that spread. And TD didn't just nudge it wider, they blew it wide open.
Okay, I'll give you that. That's a solid number. But was anyone actually expecting it? Come on, I'm literally looking at the earnings call transcript right now, and you've got CIBC analyst Paul Holden pointing out that TD's own guidance for modest expansion. Modest. Does 13 basis points sound modest to you? To me, it sounds like one of two things happened. Either they deliberately lowballed their guidance to get a nice pop, or something completely unexpected gave them a massive tailwind. So what is it? Are these guys just brilliant operators, or did they get incredibly lucky this quarter?
That's the entire point. That's not luck, that is pure strength. Wall Street was expecting modest, and TD came in and delivered an absolute blowout. This isn't about just meeting expectations, it's about completely shattering them. What that demonstrates is an operational excellence, an ability to execute that just outpaces what the market's own forecasts thought was possible. They didn't just deliver, they over-delivered. And that tells me the foundation isn't just solid, it's over-engineered, and in the best possible way.
So now, let's move up from that solid foundation and take a look at the actual blueprint for the future. The Q1 numbers, that's the what is. Now we're getting into the what will be. Management is not just sitting back and counting these profits, they have laid out a clear, multi-year plan to build this bank into a true financial titan. And the entire plan, all of it, is centered on one single critical metric.
And that metric is return on equity. For anyone who might be new to this, ROE is basically the ultimate report card for a company's management team. It measures how much profit the company is able to generate with the money that shareholders like you have invested. A high ROE means the leadership is efficient, they're disciplined, and they are excellent at allocating capital. I'm telling you, it is the single best measure of a well-built financial structure that is designed for one thing: creating shareholder value.
And this right here, this is the blueprint. TD has gone public and targeted a 16% return on equity by the end of 2027. This isn't some vague, fuzzy promise. It's a specific, measurable goal with a hard deadline. and they've laid out the steps to get there. First, they're reaching a 13% CET1 ratio. That's their Common Equity Tier 1 capital ratio, which is a key measure of a bank's ability to withstand financial stress. After that, they're planning continued cost savings and very targeted earnings growth. It's a structured, methodical, step-by-step plan to increase the efficiency and profitability of the entire enterprise.
Okay, now what's really fascinating about this is the gap that it illustrates. Getting from where they are today to that 16% target by 2027, that's going to require some serious heavy lifting. This is not going to happen by accident. It's going to demand incredible discipline and cost savings, mostly through process automation. It's going to require real intelligence in capital allocation and a forward-thinking strategy for growth in their wealth management and especially their U.S. retail divisions. They are signaling to the market that they are ready and willing to do the hard work needed to build substantial long-term value. So, the big question is, how do they actually do all that heavy lifting? Well, this is where it gets really interesting. They are embedding artificial intelligence deep into their operations. And listen, this isn't just some buzzword they're throwing out there to please the market. On the earnings call, BMO analyst Sohrab Movahedi asked them point blank. He asked if the traction they're seeing with AI would justify moving their ROE and expense targets even higher. Management clearly sees AI as the structural steel of their future growth. It's a way to lower costs, improve efficiency, and drive much higher returns. And this quote just perfectly illustrates the entire bull case. This is from TD's own research arm, TD Securities, from a report they put out last year. So they're not just talking the talk, they are putting their own analysis out there for everyone to see. They see AI as a completely transformative tool, not just for a little bit of efficiency, but as a weapon to turn a legacy institution like TD into a fintech disruptor. This is the vision they're selling. A bank with the scale and power of a fortress, but with the agility and speed of a startup. All right, that's a very nice blueprint. It's ambitious, it's glossy, and it's full of all the exciting words we love, like AI and disruption. But let's be real, blueprints don't build houses. Workers do. And sometimes the materials they're given are faulty. So now it's time for the stress test. We're going to put some real pressure on this structure and see if it actually holds up, or if all this hype is just hiding some very serious design flaws.
Let's start with this whole AI narrative. I mean, it sounds fantastic. Who doesn't love AI? But I need to know, how exactly do these buzzwords translate into durable, tangible, long-term value for investors? We have seen countless companies promise an AI revolution that turns out to be, what, nothing more than a new software license? So is this a genuine structural reinforcement that's going to drive profits for years and years to come? Or is this just rebar-thin promises that are going to bend at the very first sign of pressure? I need to see the proof.
And you know what? While we're looking for proof, let's see what the machines themselves are saying. Let's forget the narrative for just a second. We ran TD through Guru Focus, which is an independent, totally automated financial analysis platform, and it's flashing some serious warning signs. Now, these aren't just opinions from some analyst. This is a quantitative system flagging potential issues based on nothing but the raw financial data. These could be the very first signs of cracks in the armor. To be specific, the system has flagged 1 severe warning and 5 medium warnings. And the severe one, it's a big deal. It points directly to a historical decline in their operating margin over the past 5 years. Now, what this suggests is that, this one quarter was great. The longer-term trend has actually been less impressive. And the medium warnings? They point to things like slowing revenue per share growth and a book value that just hasn't kept pace. Before we get carried away with this beautiful blueprint, we have to ask ourselves, why is an unemotional, data-driven tool flagging a potential long-term profitability problem? And look, it's not just me or some algorithm asking these tough questions. This is a direct quote from Matthew Lee over at Canaccord Genuity, right from the earnings call. Even the Wall Street analysts who live and breathe this stuff are seeing the exact same thing. They see this ambitious 16% ROE target, and they're immediately asking the single most important question an inspector can ask. What could possibly go wrong here? What are the unknowns? And right there, that's the whole ball game. The unknowns. In any major construction project, this is what we call execution risk. It's that huge, yawning gap between the pretty picture on the blueprint and the messy, dirty reality of actually getting the thing built. Think about it. What happens if the economic ground shifts under their feet and loan losses suddenly spike? What if all these so-called cost-saving initiatives just don't save any costs? And what if this big AI plan is way slower, way more expensive, and a lot less effective than they're telling everyone it will be? See, the biggest risk here isn't in the plan itself. The plan looks great on paper. The risk is in the execution. And right now, there are a ton of unknowns that could completely derail this whole project.
All right, we've reviewed the foundation, we've stress-tested the blueprint. Now it's time for the final inspection report. We have to weigh the undeniable strength of the current numbers against the very real risks that are baked into the long-term plan. So, is TD Bank actually building a financial fortress, or is this an investment trap just waiting to be sprung? Okay, let's start with the bull case because the evidence is truly compelling. You have a massive, record-shattering $4.2 billion profit quarter. That's your rock-solid foundation. You've got a 13 basis point beat on net interest margin, which shows their core engine is just firing on all cylinders. And on top of all that, you have a clear, ambitious blueprint to get to a 16% ROE, supercharged by a real strategic investment in AI that could genuinely make them a disruptor. From my perspective, the structure looks incredibly sound, and they're building upwards with very high-quality materials.
But the bear case, the inspector's report, it demands caution. You simply cannot ignore external, data-driven red flags like these. The Guru-focused system is flashing one severe warning related to long-term margin compression and 5 medium warnings about things like slowing revenue per share growth. That's not just noise, that's a clear signal. You have Wall Street analysts openly asking about the unknowns and all the factors that could prevent them from ever reaching their lofty targets. The AI story is promising, sure, but right now it's a lot more promise than it is profit. These are identifiable cracks that could absolutely become structural failures if the economic environment gets tough.
Look, no major construction project is ever without risk. There will always be unknowns, but the sheer strength of that foundation gives them a massive margin of safety. A company that is throwing off this much cash and actively expanding its core profitability has the resources and the operational strength to manage that execution risk and navigate those unknowns. The numbers that we can see and touch today indicate a structure that is built to withstand immense market pressure.
And in any construction project, the cost of ignoring early warning signs can be catastrophic. We all know that. A small crack in the foundation, if you ignore it, can bring down the entire building. The question isn't whether the current structure is strong. It is. The question is whether these warnings are symptoms of a deeper underlying issue in the blueprint itself. Prudence requires us to respect these warnings and demand more proof before we go ahead and declare the project a success.
So, there it is. That's the final verdict. The blueprint to build a financial fortress is laid out for everyone to see, and the foundation, right now, looks incredibly strong. That profit engine is roaring.
But the inspection has revealed potential faults and some very clear warning signs that you just can't ignore. The risk of execution failure is very, very real.
So the final question we're going to leave you with is for your own portfolio. Do you see the opportunity here and want to be a builder, investing in this blueprint?
Or do you see the risk and choose to be an inspector, waiting on the sidelines until those cracks are repaired and the structure is proven to be sound? The choice is yours. Thanks for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.